Welcome to the Unit 8 of the course Management of Insurance Services. In this unit, we will cover a few aspects of another specialized insurance, which is motor insurance. In the previous unit 7, we have discussed about health insurance, the different varieties, types of health insurance schemes available, what is the role of government in health insurance, and how the health insurance market is in a boom state as of now. Similarly, we will look into the concept of motor insurance and what are going to be its future prospects in this module. So, in this class, we will discuss about the what is the concept of motor insurance, what are the features of motor insurance, the different acts and rules which governs motor vehicles in India. Will basically discussed about the in the Indian context. What is own damage? What is underwriting considerations? What is meant by the third party liability? What is the how are the own damage claims made, and also we will discuss briefly about the future technology, ownership patterns, and the liabilities related to this motor insurance. Now this topic, motor insurance, is not new to all of us. Health insurance and motor insurance are the most popularly discussed over topic nowadays, because the government is bringing in the state governments and the central government is bringing in so many uh, rules and regulations so that to ensure safety of the people, because the road accidents are growing in day by day. So, motor insurance started initially to protect the vehicles, and also the main focus was to protect the people who were injured in road accidents. So, its main purpose was for a social protection, but it was not started for not just a business sake, but it was to reduce the number of accidents, which was in a growing phase, and now also it is a concern for the state government and the central government. So there were several cases of hit and run accidents. In case of hit and run accidents, a vehicle, when it comes and does an accident, and the vehicle does not stay there, instead the vehicle runs away. So you don't know the whereabouts of the vehicle who has made that accident. So in that cases also, the government is liable to pay money to the person or the victim who has faced the accident by the vehicle which is unidentified. In case of motor insurance, the insurance pricing is of basically two types. It can be tariff system, where the premium in insurance, as we all know, that there has to be a premium which will be paid by the person or the individual to the insurance company. So here, in case of a tariff system, the premium and rules are fixed by the regulator, and regulator means it is the government who fixes the rules and the pricing. And in case of a non-tariff system, the premium is decided by the insurance companies, the private sectors who are providing the motor insurance. So motor insurance in India are basically, it is of two types, which we'll be discussing in the slides later on. It is one is an own damage. That means if I own a vehicle and my vehicle has been damaged by, it can be by any means. So that is known as own damage. So it is the damage of that self. And third party liability, it is suppose one vehicle hits another person who has faced an accident with the vehicle, then that type of price is controlled by the regulator or IRDAI. So in that case, the victim is the person who has faced the accident. So these are basically two types of insurance, motor insurance, which we will be discussing. Now, focusing on some of the recent data, why actually the concept of motor insurance is of prime importance nowadays, because very huge numbers of vehicles and accidents are incurred daily on day-to-day basis. India has over 300 million registered vehicles, and registered vehicles which comprise of both the two wheelers and the four wheelers, one of the largest in the world. And road crashes with the accidents, around 400 people are killed every day, and there are millions of people who are injured. So this data calls for it is a severe concern for the government to see that how they strengthen this concept of motor insurance. So that is why the motor insurance has gained a lot of importance due to rising trends of accidents and rising trends of purchase of vehicles. Now, cost of accidents is very high if we talk about India. The average repair cost after a crash can be tens of thousands of rupees, sometimes lakhs of rupees also, depends on the intensity of the damage which is done to a vehicle. And again it varies from by with vehicle to vehicle. If it is two wheeler, again the brands also, it will depend on the type of brands, also the cost will vary. Now without insurance, the vehicle owners pay all of this from their own pocket. So now an insurance is a safeguard to such type of owners, vehicle owners, who need not pay from their pocket in case of any sudden accidents which incur. So they can this insurance is a type of security for their own vehicle. Suppose in case any sudden unhappening happens to the vehicle, then it can be paid by, from the insurance, from the sum assured of the insurance. So now what does the insurance actually do? So motor insurance protects one's own vehicle. It protects the other affected in an accident, which we had talked about, the third party liability. If one vehicle is mm, crashing any person on the road, so that person becomes the third party. So now the insurance company will pay to the for the damage of the third party, that is known as third party liability. So it is in this essence, motor insurance is one of the largest non-life insurance products in India. So that is why health insurance as well as motor insurance both play a very significant role in Indian context, basically, and it is in a boom stage. There are basically two main parts of motor insurance, as I was just telling that motor insurance are divided into two specific dimensions. Before going to the dimensions, let us understand very clearly that when we are talking about two parts, it is damage which is done to a particular cell, that is for a individual. Suppose I own a vehicle and my own vehicle, it gets damaged. Then suppose I am driving and I have uh, crashed my vehicle. So it is the one which protects your own vehicle, that is own damage. And suppose I am riding my vehicle and I cause damage to another person who is going on the road. So that then that is the protection of others. So it is in two different parts. One is it is protecting one's own damage. Second one is it is protecting the damage which is caused by others to another party. So it is a third party liability. So both the dimensions are, first one is one damage, that is OD. Own damage insurance covers the damage to your own vehicle. So when it will cover the insurance, the damage of your own vehicle, when my own vehicle meets with an accident, when my vehicle is stolen, or when my vehicle is set on fire, or it is a flood, or maybe cyclone, or any sort of natural calamities have affected my own vehicle, then it is known as own damage. And as of today, any minor accident which can cost around 20,000 to 50,000 in repair. So cost is going to be, it is rising day by day due to inflation also. And some major accidents which are incurred, then the cost can go up to several lakhs, especially in four wheelers. And if we don't spending this amount in repairs, will be heavily out of the pocket expenses of any individual, and which is unplanned. So that is why it is very important that every individual who owns a vehicle should go for a motor insurance for his own safety or security. Then comes the third party liability. As we discussed, that suppose a vehicle is injuring some other individual, then that is known as a third party liability. So third party liability, it covers the loss which is not caused to your own vehicle, but it is caused to another person from through your vehicle. That is a third party liability. So it would include the injury to another person from your vehicle. It can be only injury, it can be death, or it can be damage to someone else's property. Suppose your vehicle has hit the vehicle of another person, so then becomes the third party liability. So now here the loss of the third party, the other individual, will be compensated by the insurance company. So this is again a very good coverage or security on part of an individual. So here, third party insurance in India is very much mandatory by the law which is given by the government. And why this law is has been made mandatory? Because as our law in India, it gives priority to human life, not the vehicle damage. So anyone who is affected by the vehicle of one individual, that uh, amount, the loss will be compensated by the insurance company. So these are the two main parts of a motor insurance. So we will discuss about this elaborately, what is own damage and what is third party liability. Now let us discuss about the policies of and the different types of vehicles which are there. We are only discussing about the Indian context, a few aspects of the policy, vehicles, and the pricing. So now vehicles covered under motor insurance are two wheelers, they are cars, four wheelers, commercial vehicles, which are trucks, buses, etc. And there are special vehicles like ambulance, tractors, crane, etc. So these vehicles are basically covered under the motor insurance. So almost every road vehicle must be insured. It is now a mandate of the state governments as well as the central government, that each and every vehicle which are riding on the road has to be insured. And nowadays few state governments have also linked it with the petrol pumps. So the vehicle which is not having an insurance will not be cannot get petrols from the petrol pump. So insurance now is a must for each and every vehicle. So insurance policy means it is an agreement, it is a written agreement, and that clearly mentions what is covered, what is not covered, and the rules and conditions. What is covered, like suppose there is a two wheeler, and suppose in case of an accident, the insurance policy will cover the entire damage of the two wheeler. So that is what is covered. Or or suppose you have a car, and the insurance policy, in the agreement it is written that only the damage to the cars of the you can say the different specifications, like the different tools in the car, or only the mod guard, all those iron equipments which are there in the car, that will be covered, and the fiber equipments in the car will not be covered. So it will be clearly mentioned what glass, sometimes glasses are not covered, so it will be clearly mentioned in the agreement what portions or how, which specification will be covered for that vehicle damage and what specifications will not be covered. So all the conditions will be mentioned in the written agreement. And yes, if and with a certain premium, when we are having a motor insurance, the individual has to pay a certain premium for that. But yes, suppose you want some add-on covers apart from the basic policy, like suppose say for example zero depreciation, so in that you have to pay a extra premium. So premium plus, if you want to have a zero depreciation, you need to pay a the premium amount will be a bit higher. So in case of own damage premium, it is decided own damage premium is as we have discussed, it is for your own vehicle. So in that case, it is decided by the insurance companies, and it is again based on the premium is based on the vehicle value at that point of time, the year number of years the vehicles have been now run, and the risk prone of that specific vehicle. So all these factors will have an impact on deciding what is going to be the premium of that vehicle. Next one is third party premium. It is fixed by the government or the regulating agencies, and that is same for all the types of insurance companies, since it is fixed by the regulation, a regulatory body. So that is why such type of premium is same for all the different types of companies which are providing the motor insurance. Here, because the difference between this own damage premium and third party premium is because here in case of third party premium, the life or injury of a person, it is related to that. So that is why any insurance company cannot fix a value. Suppose a person dies, so insurance companies cannot fix up the value of a death of a person. So that is why it is not left over to the insurance companies to decide on the third party premium. That is provided by the government, fixed by the regulator or the government. Now let us briefly understand the Motor Vehicle Act. We'll understand the fundamentals of it. The Motor Vehicle Act tells us how vehicles should run, who pays when the accidents happen. So what should be the basic principles or guidelines based on which every motor vehicle should run on the road? So that is specifically mentioned in the Motor Vehicle Act. And suppose there is an accident, who is liable to pay for that? So that all those specifications is mentioned in the Motor Vehicle Act. So Motor Vehicle Act was introduced in 1939, and which was replaced by another by the Motor Vehicle Act in 1988, and this came into force from 1st of July 1989, and this act is applicable to the entire whole of India. So there is no specific act of motor vehicles as per like it is not segregated to different state governments. So the purpose of this Motor Vehicle Act is to regulate vehicles on roads, ensure road safety, control insurance and liability, protect the accident victims. So you might have seen on highways the particular speed limit is written. So now that is again coming under this Motor Vehicle Act. So every vehicle has to abide by the speed of which is mentioned in the roads, speed limit. So all those things, that is only to safeguard, to ensure that road safety is maintained, and there is less number of accidents or negligible accidents on the road. So that is why the act specifically lays down all the aspects which are related to a vehicle while riding on the road. Central Motor Vehicle Rules in 1989 was issued by the central government, which provides guideline for implementing this Motor Vehicle Act. And the states also follow these rules while they make their own procedures. As I was telling, recently few state governments, they have linked it with the petrol consumption. If you don't have the insurance, or if you don't have the pollution certificates, then you will not be able to avail the petrol from the petrol pump. So now the state government follows the central motor vehicle rules, while and they have to link it with their own procedures of the different state governments. Now the Motor Vehicle Act focuses on helping the victims first, and later on the arguments follow. So whenever there is a third party liability, whenever there is a maybe hit and run accidents, or whenever a third party is facing the loss or having an accident, so in that case the law is more flexible towards the victim. So there are different types of liability, like no fault liability. Here, the victim gets compensation without proving his fault. In that case, the victim, the person who has faced the accident, suppose the person is injured, then the person, without proving anything, or without giving any evidence, the person will get the compensation from the insurance company. Third party risk: insurance must cover injury, death, or property damage to others. So, this is the third party liability. Suppose anyone is having injury from one's vehicle, or anyone is dying, or there is any property damage of any other person from the vehicle of another person, then it is a third party risk which will be covered under the policy. Hit and run accidents we have discussed. In hit and run accidents, here hit and run accidents means the vehicle which has caused the damage, that vehicle is not traceable. So the vehicle has hit the person, and the vehicle has is absconding. So in that case, when you cannot identify the vehicle, in that case the compensation is paid through the government supported funds. Next one is hazardous goods. Insurance is also provided. Motor insurance also gives protection for losses during the transport of hazardous materials. Like suppose there are you can talk about few medications, drugs, or injections, or different antibiotics, or different types of hazardous materials which are being transported from one place to another. So in that case also insurance is done, vehicle insurance, motor insurance is done, so that it will safeguard the losses of such type of hazardous materials. Nowadays, it has changed from unlimited liability of insurers to limited liability of the insurance companies. That means, as in case of health insurance or life insurance, we have seen that a particular limit, a sum assured, is fixed for the insurance. That means the insurance company is liable to pay, let us say the sum assured is 7 lakhs. So insurance company will pay not beyond 7 lakhs. The loss has to be within that 7 lakhs. Similarly, here also you have they have set limits. So suppose there is damage, then damage cannot go beyond a particular limit. The cost of damage cannot go beyond. So the insurance companies are liable to pay up to that particular extent, as it is mentioned in the agreement or the policy. Like suppose a motor insurance, here there it is mentioned that the the damage, the limit is around 5 lakhs. So the any sort of damage which is caused can be under 5 lakhs, which is being compensated by the insurance company. If suppose your costing is more than 5 lakhs, suppose the vehicle is completely damaged and your cost of repair is more than 5 lakhs, then the company will also bear only within 5 lakhs. It will not exceed beyond 5 lakhs. So limits have been introduced to make this insurance more practical and sustainable, because the insurance companies also have to sustain themselves in the market rather than making losses. So there are vehicle classifications under the Motor Vehicle Act. Types of vehicles: motor vehicles, any mechanically propelled vehicle which is used on roads can be denoted as motor vehicles. This, I think, each one of us is aware about this. So when we talk about light motor vehicles, LMVs, these are vehicles which weigh up to 7,500 kg. These are the light motor vehicles. Medium motor vehicles are weighing between 7,500 to 12,000 kg. And there are heavy motor vehicles which weigh above 12,000 kg. And there are classification based on the usage also, like contract carriage, vehicles which are hired for passengers like cabs and all, they are hired vehicles for the passengers. Stage carriers are public transportation with fixed route like buses and all. Goods vehicle, those vehicles which are used for carrying goods. Private vehicles are, all of us know this, these are for personal use, personal vehicles. And there are few special terms like trailers. These are vehicles which are pulled by another motor vehicles. Certain vehicles are pulled by another motor vehicle, so these are known as trailers. And there are another vehicles which are known as articulated vehicle. So it is a vehicle plus a trailer, which is a combination of a vehicle as well as a trailer. So this is something which is more bigger version. So these are special vehicles which are classified as per the Motor Vehicle Act. Now let us go elaborately to the different dimension, two different dimension. One is own damage, other one is a third party liability. Now what is own damage? Own damage is, as we have discussed, that it is own damage in case of motor insurance, it is covering the loss of the damage of one's own vehicle of an individual. So suppose I have a car, suppose I have a bike, then I am compensating the loss, or I am safeguarding the loss of my own vehicle. So it applies to car or bike, its accessories of the car or bike which I own. And what the own damage insurance protects against. Now suppose my bike or my car is under fire, explosion or lightning, whether my bike or car has undergone threat, someone has taken it, or burglary or housebreaking. Suppose my car has met with an accident or collision. Suppose there are some natural calamities which has caused damage to my vehicle, or maybe during riots or fights or any sort of malicious act, my vehicle has been damaged, or any sort of terrorist activity, or suppose I am shifting clothes from one place to another, then during the transit there is damage to my vehicle. So such type of damages are being protected in the motor insurance under this own damage category. So own damage pays when your own vehicle gets damaged. It's not of other vehicles, but it is your own vehicle is affected. That is known as own damage. So, what is not covered in this own damage category? So, insurance covers accidents, not negligence. This needs to be remembered. It is covering accidents, but it is not covering the casual negligence of a driver. So, own damage insurance does not pay for normal wear and tear of your vehicle. Normal anything has happened, like suppose there is a oil filter leakage, suppose there is a normal repair thing which is to be done, suppose your brakes are not functioning properly, so suppose there is a tire issue, so all this normal wear and tear of the vehicle is not considered under this own damage category of insurance. Then mechanical or electrical breakdown, damage due to drunk or illegal driving. So whenever there is, we are claiming for insurance in a OD, then there is an inspection which is undergone, and in that inspection they see that whether the driver who was driving that vehicle is in normal condition or whether he is drunk or he was doing any sort of illegal driving. Nowadays you might have seen in uh, televisions, you might have seen people, or not only in television, in real practical scenario also you might have seen people uh, who are undergoing different stunts while driving. So that is known as illegal driving, and they do not worry about the speed at which they are driving. So that also they will not consider for providing, giving or settling a claim if the damage is due to drunk or illegal driving. Damage outside India. Now, in this case, now this law is applicable within India. Now, if the vehicle uh, is outside India and the damage is outside India, then the motor insurance will not be covered. The claim will not be covered, settled if the damage has been incurred outside India. But yes, in specific policies, it is mentioned that yes, they will cover the damage if it is outside India also. Accidents caused while using vehicle for an unauthorized purpose. Now, suppose there is any sort of malicious activities which is being conducted in that vehicle. Suppose you are trying to transport some illegal goods from one place to another. Suppose any sort of illegal activities is conducted in that vehicle while the accident was caused, then in that case also the motor insurance will not settle the claim. So these are different types of uh, you can say different types of activities which under which circumstances the motor insurance companies will never provide or settle the claims when it is claimed under the damages which are caused, which are linked with such type of activities. So if the vehicle is damaged but no accident has happened, so and OD will not pay. So accident has to happen. Whenever the own damage claim is settled, they have to be proved that the accident has happened. But when suppose the vehicle is standing and any sort of damage is there, no accident is there, so then the OD will not be liable to pay for that. Now, we were just discussing about that there is some basic agreement which is mentioned in the policy that under such circumstances, the vehicle agreement, the motor insurance will be repaired under this particular agreement. Like suppose there is a accident which is caused and the glass items will not be considered, damage to the glass items, damage to the fiber items will not be considered, damage to the engine will be considered, damage to the other different parts of the vehicle will be considered. So it will be clearly mentioned in a basic policy. But there can be certain add-ons which can be added to the basic policy, but that will call for a higher premium. So any own damage policy with certain add-ons, basic or own damage policy will call for a normal premium. But when own damage policy with certain add-ons, then the protection will be more better, and obviously they will add more premium to that. So the person has to pay higher premium for the for taking these add-ons. So depreciation is reduction in value. So insurance pays after reducing the value of the old parts. So the vehicle, as we all know, the vehicle as it grows older and as it is run on the road, there are wears and tears in the vehicle. So that is why the insurance company calculates the value of the vehicles by reducing the depreciation of the parts which are being worn or torn. So, for example, the tires and batteries are considered as 50% depreciation. Glass parts, they do not calculate the value as depreciated amount. And vehicle age, suppose the vehicle age is up to 6 months, there is no depreciation. They do not charge any, calculate the value by reducing the depreciation. But if the vehicle is 1 or 2 years old, then the depreciation is accounted for as 10%. So the value of the car will be calculated after reducing the depreciation amount by 10%. If it grows on older 3 to 4 years, then the depreciation becomes 25%. And if it is 5 to 10 years, then up to 40 to 50%. So this is how they are gradually calculating the depreciation and finding out the value of the vehicle. But in some cases, suppose you would like to go for zero depreciation. Zero depreciation means they will not deduct or they will not calculate the value of your vehicle, car or maybe bike. They are not depreciating the spare parts and calculating the value. So they will consider it as per the market value. So in that case, if you are taking a zero depreciation as your add-on covers, where your value is calculated without deduction in the depreciation, then in that case you have to pay a higher premium. So this is add-ons or covers for extra protection. NCB protection, it claims it keeps no claim bonus safe. Roadside assistance, breakdown towing help is is there as an add-on. Suppose there is any breakdown while you are traveling in a highway where you don't have any repair shop. In that case, you get a roadside assistance. That is again added to your insurance. Cash allowance, extra daily cash during repairs. Extra daily cash during repairs is suppose when you are going for repairs, you are going to get some cash allowance from the insurance companies for the repairs. Alternative vehicles, these are temporary replacement vehicles. Suppose your vehicle has been broken down unexpectedly in on a highway, that you cannot you do not have or you cannot repair it instantly, then you get a temporary replacement vehicle unless and until that your car is repaired. And another add-on can be EMI cover. So these are different. There are so many other specifications also. Some examples we have given as add-on cover. So as the add-on covers are added to the basic policy, the premium becomes more higher and higher. So this is how the policy works out. Now let us move on to the insured declared value. So when we talk about a pricing or premium which is fixed by the motor insurance companies, they have need to calculate the insured declared value, IDV. IDV is the current market value of the vehicle. It is the maximum amount the insurer will pay if the vehicle is totally damaged or stolen. So as I was telling that when it is a zero depreciation, in case of a zero depreciation, here there the IDV is the current market value of the vehicle. That means they are not reducing the depreciation of the different parts and calculating the value. The current market value is the value of the vehicle. But in case of maybe 50% depreciation on the spare parts, then what happens? The IDV is the current market value, which includes the depreciation of the spare parts also. So IDP is nothing but it is the amount, or we can say the limit, which the insurer will pay. We were just talking about in the previous slides that there is a set limit. Initially there was no limit, but now there is a set limit, which is the maximum amount which the insurer will pay if the vehicle is totally damaged or stolen. Now, how they are deciding on this IDV, insured declared value? The IDV is based on the original invoice value, the value at which you have purchased the vehicle, the age of the vehicle, the number of years the vehicle has been on the road or purchased, the depreciation, as just I was telling you about the depreciation, the reduction in the value of the different spare parts. By considering that also, you are going to calculate the current market value of the vehicle. So lower IDV means the lower premium, but the lower claim amount also will be there. Higher IDV means higher premium amount and a better claim amount will be there. That means a limit will be set higher. So IDV is not actually the purchase price, but it is the real price of that vehicle, considering all these three aspects: the original invoice value, age of the vehicle, as well as after reducing the depreciation of the different spare parts. The vehicle, the insurance, and the usage factors. So the vehicle's age and brand also matters while fixing up a premium. So when the vehicles are older, risk of damage is also higher, and there in that case the premium is also higher. Some insurers do not insure vehicles beyond a certain age. They only insure a selected brands of vehicles, as well as in case of the insurance, the experience of the insurer is concerned, insurers prefer vehicles with a low risk history and owners who are having a clean driving records. So they have to see what is the accident records of that owner who is driving, or the person who is driving the vehicle. So private versus commercial vehicles have different risk levels. So the vehicle's age, brand, and past experience matters to the insurers. So whenever the motor insurance company is deciding on the premium, they will see the vehicle age, they will see the vehicle brand, they will see the experience of the driver who is using that vehicle, and how many times that vehicle has made accident, and how many times it has been repaired. The entire experience of that vehicle they will see, history, or you can say that entire disease check of that vehicle will be done by the company, motor insurance company, before they fix up the premium for that insurance. Pay as you, now these are the modern trends of motor insurance. Pay as you drive. Premium depends on the distance travel, the number of kilometers that has been traveled by the vehicle, and the usage pattern. Whether the vehicle is always moving on long route drives, or the vehicle is only going for dropping children to their school. So they have to see what is the usage pattern of the vehicle, whether it is a low usage pattern or a high usage pattern. Based on that, they will fix a premium. So less driving or usage of the vehicle will call for a low premium. So insurance companies also, they have tie-ups with garages. So insurers partners are with the authorized garages. So whenever there is a insurance repairs claims, and you have to repair, you have to repair in certain specific garages which are mentioned in the insurance policy. Like in case of health insurance, there was a network of hospitals which will be mentioned in that insurance paper agreement. So whenever there is any issue of health, you have to be admitted in that particular hospital. Similarly, whenever there is any case of repair or damage, you need to go to the authorized garages of that insurance company in order to get the repairs done. So the benefits of that authorized garages, if you suppose you go and get your repairs done there, is you will have a faster repair, you will have cashless claims because that will be paid by the insurance company, and there will be better service quality. And there is nowadays the modern trends are a technology based pricing. There are mobile apps of insurance companies, gps or vehicle data are used. It helps the insurers to assess the actual driving behavior, because now initially there was a manual cross checking of the incidents. So whenever there is an accident, you need to prove the insurance company that the accident was a normal thing, it was not in something with illegal behavior, or maybe in any drunken state someone has made an accident. In that case, there was a inspection by the team who goes and assesses. But here, when there is a, now it is a technology driven uh, uh, driven thing. So here what happens, with the help of technology, the insurance companies can very well assess the actual driving behavior of that person, and they can quickly settle the claims. So today, how you drive matters as much as what you drive. This is the basic change in the viewpoint of the motor insurance companies. Now we were now discussing about OD, the own damage. Similarly, the next dimension is the third party liability. This we have understood that the third party liability means legal responsibility to compensate another person if a motor vehicle causes death or injury or damage to a property. So if a motor vehicle is causing damage to another person's life, suppose death is there, suppose injury is there, he might be paralytic, he might be disabled within the accident. So in that case, it is the responsibility that that person is should be compensated, because it was not his fault, it was the fault of the vehicle of one particular individual who has caused the damage to the uh, personal property or the health of the other individual. So who is the third party here? The third party is the person who is actually the victim. It is not the insurer, it is not the company, insurance company, it is not the vehicle owner, but it is the person who is the victim, who has faced the accident. So it is the insurance company or the person vehicle owner is now liable to pay to the victim who has faced the accident. So third party liability insurance is compulsory as per Indian law, is to protect the accident victim, to ensure quick compensation to the victim, and to avoid any financial burden on the on the vehicle owner. Nowadays what happens, the vehicle owner is sometimes might not be driving the car, and there are owners who are like Ola cab and all. So there the driver is a separate person, the owner is a separate person. So in this case, the driver, suppose the driver has hit some person who is the victim. So here but the financial burden is not on the driver, but the financial burden is on the vehicle owner. So vehicle owner, now then it will be a sudden financial burden on the vehicle owner. So in that case, it is good that the vehicle owner should have a motor insurance to protect all these third party liability cases. So TPL, what does this third party liability insurance cover? It is as per the Motor Vehicle Act. TPL insurance covers the death or injury to the third parties, passengers of public service vehicles, and damage to the third party property. So these they will cover the death, whether the person is dead or injured, or the passengers of any vehicle. Suppose it is a public transport, all the passengers, health of all the passengers who are inside that vehicle, or any third party property. Insurance companies pay the compensation here. Fault or negligence need not always be proved in this case, and liability for death or injury is unlimited here. So it is the fixed by the government, as we discussed, that if suppose in case of death, that is fixed by the government. So we cannot fix a certain amount of limit of value for one's death. So it is fixed by the government. So insurance company can refuse the payment of such type third party liability only if the driver have no valid license. If the driver is not having any valid license, as I said, the owner can be separate one, driver can be separate one. If the driver is not having a valid license, then insurance company can refuse to settle the claim. Vehicle was illegally used and policy obtained was by any sort of fraud. So in such instances, the motor insurance company might not settle the claim of this TPL. Motor Accident Claims Tribunal. There is a court of justice that is known as MACT and Lok Adalat. MACT is Motor Accident Claims Tribunal. There is a special courts for these accident cases. These courts are faster than the regular courts, and the compensation is decided for these accidents. The compensation is decided based on age, the income, and the type of injury. This is actually related to the third party liability. There is no time limit to file a claim. Anytime anyone can file the claim, and these type of cases are resolved at a faster mode. So if there is a no fault liability, then in case of a death, no fault, here the third party is not having any fault. So in that case, if suppose the person is dying, then he will get a compensation of rupees 5 lakhs. If the person has suffered from permanent disability, suppose he has broken down his leg, suppose he will not be able to walk, or any sort of permanent disability, then he will be paid 2,50,000. And no fault liability means he is going to be paid without proving or giving any evidence about the fault. So that is known as a no fault liability. And the Lok Adalat, this we were talking about the tribunal court. This ensures speedy and low cost settlement, and it award is final and binding. Any sort of uh, judgment that is given by them to the victim or to the person who is the owner, that is final. So they cannot appeal against this judgment to any higher court. So that is why no appeal will be allowed. So here, that is why the settlements or the resolution of the different cases are very faster in such type of courts. Now let us discuss quickly about the OD claims. OD claims is own damage claims, which is done for your own vehicle. It covers losses due to accident, fire, theft, natural calamities. We have already discussed. OD claim is different from the third party claim. Here, the vehicle owner claims for his own vehicle losses. So, types of OD claims are partial loss, total loss, constructive total loss. So, what is this partial loss? It is, we are talking about now the claim for own vehicle. So, vehicle is damaged but can be repaired. Vehicle has been damaged but it can be repaired. So, repair cost here in this case is less than 75% of the vehicle value. We have now discussed how are we going to calculate the vehicle value. Vehicle value minus the reducing the depreciation cost. So insurance pays the repair cost, that is after depreciation. That means suppose a car hits a pole and the bumper and headlights are damaged. This is just an example. So then the insurance company repairs. So it is a partial loss. So you can repair the vehicle. Total loss is suppose your car or vehicle is completely damaged. So, and here repair is not possible. So, insurance will pay the full IDV. Now, IDV is again calculated by reducing the depreciation cost. And if it is zero depreciation, then IDV is the current market value. So, if your car burns in fire and it cannot be repaired, so total loss is your full IDV, the value of the vehicle. Constructive total loss is vehicle can be repaired, but repair cost is very high. So in this case, also the insurance companies pays the entire IDV. So car is badly damaged in an accident, and repair cost is almost equal to the cost of the car. So that is known as the constructive total loss. Here also you are getting the entire car value, but here depends on the car value is again calculated by considering the depreciation. Now OD claims, how the process works. Suppose an accident happens, that accident is again that informed immediately to the insurance company, that who is the insurer. Now you have to take the photographs of the damage at that point of time and the location. Then if required, sometimes you have to lodge a FIR with the police. Then the vehicle inspection is done by the insurer, a surveyor. They have to go to the person and they have to inspect everything. They have to take certain proofs of that accident and all. Then they will take the repair approval and finally the claims will be settled. So now looking into the future technology, ownership and liability of the motor insurance. Earlier what happened, people bought and owned their own vehicles, but now and in future people use vehicles without owning them. Like for example, Ola, Uber, car rentals and car subscriptions. These are now they are only just using the vehicles. Drivers are using the vehicles. Owner is someone else and the driver is someone else. So earlier the insurance was for one owner and one vehicle. But here now the insurance is for how the vehicle is used. As I was discussing the pattern, whether the vehicle is for commercial purpose or the vehicle is for only personal use. So the main essence is that you pay only for the distance you drive. You pay based on how safely you are driving your vehicle as per the usage pattern. And the short-term insurance is there instead of yearly insurance based on how much distance you are driving your vehicle. So the role of technology also is changing, and why this change is happening, because nowadays vehicles have GPS sensors and cameras. All the vehicles have the technology, advanced technology inbuilt in the vehicles. So it is now helping to track the actual driving behavior of the person who is actually driving on the road, and it can detect the accidents very quickly. It will also reduce the false claims made by the owners of the vehicle, so that ultimately there can be a fixed insurance premium which is fair. Initially, earlier, it was since there was less evidencing, it was very difficult to prove the actual claim, whether the claims was true or false. But nowadays, since with the advance of technology, the claims are being made fair and the premium also are set very fairly. So who is responsible if an accident happens in future? Earlier, the driver was responsible, but nowadays, in future, it is going to be the responsibility of the vehicle company. It is going to be the responsibility of the software or the fleet owner. And in the future situations, we expect that the accidents might reduce, repairs will become more expensive due to inflation, claims also will be fewer, but it will be costlier. So insurance companies should focus on vehicle technology failures, software errors, and fleet insurance. So this is all for this unit. In the next unit, we will learn about the property insurance. Thank you.